Okay, so welcome to CFA Level 1. Uh, Students who have unfortunately couldn't clear, for them as well as the students who have joined now, for them, let me introduce CFA, and those who have already know what are the subjects and all. Let us see what are the changes what we have. Okay, fine. So basically, there are, as we know, that there are 10 subjects. Okay, so we have QM, quantitative methods, which is full of maths. Then we have economics. Everybody knows what is economics except the people who have joined from the science background. We have financial statement analysis, basically income statement, profit and loss, what we call balance sheet and all, analysis of that. Second is corporate issuer. Okay, so what is corporate issuer? It is basically capital uh, budgeting types, means where you come to know whether to take up the project or not. Investment analysis, what you do. Okay, that is corporate issuer, what it talks about. Like the people who are from graduate level here, they might be knowing that there is, means capital has a cost. Okay, so every capital of what the company takes has a cost. Capital is never free. All those cost of capital and how to calculate, that we learn here, corporate issue. Okay, then we have basically equity, that is stocks. Okay, then we have fixed income, that is bonds. All types of bonds we are going to cover at level 1. Then we have derivatives, fine. And one more subject, that is alternative investment. These two are called as equity, bond. They are called as traditional investment. Okay, basically we have some alternative investments, like you can invest in uh, real estate. That is alternative investment. You can invest in paintings. Okay, some people have a hobby of collecting some rare collections. All these things now comes under alternative investment. Okay, and then obviously there is hedge fund, private equity, and all those things what we are going to see. But the another one what we have is portfolio management. Okay, portfolio management means overall what, how you can manage the portfolio of an individual, or how to manage a portfolio, what are the, what is active management or this passive management, all those things what we have. And then the last one what we have is ethics. So 3, 3, 6, 9, and last one ethics. Basically in 22-23 what we have seen, 23, the weightage of the QM was 8 to 12%. In 24 it has, they have reduced it to 6 to 9%. Okay, so there is a reduction, fine. Economics again, it was 88 to 12%, now it is 6 to 9%. Why we are doing all these things? So that we can know that the some of the where the weightage is more, like let's say FSA was 13 to 17%, correct? Now it is 11 to 14%. That means see 14% of your paper now will be comprising of FSA. First morning session, I'll come to that, that how many sessions we have and everything. So you have to focus more on this thing. Is that clear? Means you can't leave FSA, because if you leave the FSA, the paper means 100% you are going to create a blunder. 100% guys. Next you have corporate issuer, which was 8 to 12%, and now it has come down to 6 to 9% overall. Right? There is a reduction. Equity was 10 to 12%, but they have increased the equity proportion, that is 11 to 14%. This was also 10 to 12%. It has become 11 to 14%. So major increase what we have, the weightage has been increased to 2024 in equity and the fixed income. Derivatives remains the same, 5 to 8%, 5 to 8%. Okay, so again alternative investment was 5 to 8%, which has increased to 7 to 10%. That means alternative has also become important. Same way PM, which was again 5 to 8%, now it is 8 to 12% increased. If you see in the second part, now everything has got increased, correct? After equity, right? Everything has gained importance except derivatives. And ethics remains the same. That is 15 to 20% of your paper would be ethics questions. That remains the same. Is that clear? This is the overall. So those who are repeaters, unfortunately, those who have got failed. Okay, now see, this is the change where you should focus. Fine. Now, what's interesting to see here is that the practical focus on this part. Now, why they have increased the weightage? Because they want to they want to make it more practical. Fine. So they have increased this topics now, equity and your fixed income derivatives and all this. The weightage has been increased because if you see FSA QM now, they are more theoretical. Theoretical numbers are there, but at the same time it is not means those are the tools. But practical aspect, as a CFA, the CFA is more focused, means it should be very well versed with equity and fixed income especially. Correct? So these are the changes. Okay. So there are some these are for the repeaters, means those who are repeating the topic. Okay, some of the LOS learning modules, okay, have been removed, and those learning modules are like, if last year we had. So coming to the portion, there are total 93 modules. Okay, learning modules means chapters, you can say, in Indian context. So we had 73 modules in 2023. Now we have 93 learning modules. Okay. So what has happened is, in 2023, many of the readings were removed. Okay. But now what they have done is, most of them have been replaced, or they have changed the name. Okay. Something like that, or minor changes are there. But except that, what has come is learning module 13 now, which is your introduction to geopolitics. Okay. This is one of the topics which has been introduced. So this is my first chapter, that is a learning module. Okay, which is rates and return. See the name, rates and return. When I say rates and return, now rates means what? The interest rate. Because guys, generally what used to happen, whenever we used to start, we used to start with time value of money, the next chapter, basics of financial mathematics. Now, basics of financial mathematics, to calculate the present value, future value of the cash flows, we require what? Interest rate. So here we are going to understand what are the different names of the interest rate. Okay, and why they are called like that, means what are the names, means what is the reason behind calling those names. Okay, why we call interest rate as required rate of return, or why we call it discount rate. See the first one, interpret the interest rate as discount rate of return, discount rates, opportunity cost. Okay, and the second part, let's not dive into the second part, okay, of the first question, of the first LOS. Let's understand why it is called as required rate of return. Now understand, see, let's say keeping our relations aside, you borrow 5,000 from me and you say that, sir, I will give you this back after 5 years. So if you are going to give me back after 5 years, guys, tell me one thing, will I accept 5,000 from you? Never. I will say I want extra. Correct? Now, how that extra is calculated? That is calculated using what? Interest rate. Obviously, I will not take 5,000. I will take something extra. And that extra, no, that I calculate using interest rate. Okay. So, obviously, if there are two people, let's say Mr. X and Mr. Y is there. If Mr. X is more risky, I am saying, risk is more, and Y is less risky, what I want, the interest, what I will charge to Mr. X, if let's say it is 12%, then here it will be 10%. More riskier the investment, simple logic, more with the interest rate, that is the more is my required rate of return. I require something extra, therefore interest rate is called as what? Required rate of return. Very simple. Whatever you want extra for a particular investment is known as required rate of return. Okay. The another name for interest rate, one is required rate of return, RRR. my favorite word. And then is discount rate. Okay, now understand, when I say discount rate, understand what happens is we will be doing this in corporate issue. Some project is there, let's say, and the investment is 50,000, and the project, you have analyzed that initially you have to invest 50,000, and then I will get 10,000, 20,000, 30,000, 40,000, 50,000, something like this for 5 years. Now, when I analyze this now, guys, to make the analysis whether this is good for me, whether it is beneficial for me or the company, what I do is I calculate the present value of this. Second chapter. Okay, we will learn. Okay, so we will calculate the present value. To calculate the present value, what I require is interest rate. Okay, what I am doing is, when I am calculating the present value, I am discounting, I am pulling those cash flows. I am bringing this cash flow 1 year back, I am bringing this cash flow 2 years back, I am bringing this cash flow 3 years back. Because I discount it, therefore interest rate is also called discount rate. It is also called discount rate. So another name for interest is discount rate. Why it is called discount rate? Obviously, 10,000, please understand, 10,000, which is at the end of the first year, obviously when you discount, you divide it by some factor, the value what you'll get may be 9,090 or something. Value has got reduced because today's value is 9,090. In future with interest it will become more. Therefore it is called what? Discount rate. Understood? Those who are attending for the first time, have some patience. We will understand everything. For the time being, when I pull the cash flows, the rate to pull the cash flows is known as discount rate. Another name for interest rate is discount rate. First one is what? Required rate of return. Second one is discount rate. Fine, we'll see this. We're just learning that what these interest rates are called, how to calculate the present value and everything, how to analyze the projects, everything we will learn. Another name for interest rate is opportunity cost. Now, what do you mean by opportunity cost? See, understand, I'm doing something, and because of that, I can't do something else. So, whatever I can't do now, that is my opportunity. That involves a cost. Okay, so I'm losing something because I'm teaching. I can't join the industry because I'm passionate to be a teacher, right? So, I'm not getting the salary from the investment banking or anywhere in the industry, right? So I'm not, means the salary which I would have got if I would have worked is opportunity cost. Is what? Opportunity cost. Obviously, because this 5,000 I gave it to you, right? I'm losing something. I would have used it, I would have invested it somewhere else. I'm losing that opportunity. Therefore, interest rate is also called as what? Opportunity cost. Is this clear? Three names we have learned: RRR, discount rate, opportunity cost. Coming to the later part of this LOS, explain an interest rate as a sum of. Now, how this interest rate means, I said I will be charging you 10%. How I arrive to 10%? That is the question. So that is what they are focusing on now on. Sum of real risk-free rate and premium that compensate the investors for bearing distinct types of risk. Okay. Sum of real risk-free rate. See the word real risk-free rate. Let us break this down. Let us break this word. Real risk-free rate. Let us understand what is risk-free rate. Very simple. What is risk-free rate? Risk-free rate is nothing but the rate, the interest what you earn when the investment is risk-free, means there is no risk in that. Okay. When there is no risk in that, risk-free. Government securities. Governments issues the securities. Government bond is there. Understood? So obviously government also pays the interest. Now it is assumed that government will not default. Correct? So there is least risk or there is no risk. Let us assume there is no default. So there is least risk. Therefore, this investments, government securities, what you earn on the government securities are known as risk-free rate of return. Is that clear? What you earn on the government securities now, because government securities are risk-less, correct? So they are known as, there is zero probability of default. What I am saying? Zero probability of default, correct? Understood? That is known as risk-free rate. What do you mean by real? Let us keep it simple. Nominal rate is made up of real risk-free rate plus inflation premium. Means real risk-free rate does not include inflation. See, obviously, as an investor, okay, I will love to earn the inflation also. Why? I will tell you one basic example. If let's say the government always it focuses, no, let's keep the inflation less, let's keep the inflation less, lower, lower. Why? See, somewhat inflation is good for the economy. Okay, I'm diverting from the topic, but let's understand, because overall the subject needs to be picked up. Okay, economics and everything. Somewhat inflation is good. Deflation is very bad. Deflation is very bad. Inflation somewhat is good. 4%, 5% inflation is okay, because it shows that the country is growing. So let's say if the inflation is very high, let's say 10% something. So if the inflation is 10%, expected inflation, what you could have bought today at $100 you will have to spend 110 after 1 year. Now let's say your interest rate what you are earning now on the investment is 6%. What I said? Here I said inflation is 10% and the return what you are getting is 6%. That means if you invest 100, after 1 year you will get 106. Correct? As I said, see, because you are not buying this, you are not buying today and you are investing, correct? And when you invest today at 6%, let's say, so what you will get? 106. 106 after a year. Okay. And after a year, when you go to buy this product now, you will have to pay what? 110. So extra $4 you will have to spend from your pocket. Right? It's bad. People, when they see that inflation, expected inflation is 10% and return what you are earning is very less, you will prepone your purchase and today only you will buy. You will not buy it after a year. Simple. Understood? So always now this return should include what? Inflation premium. Should include the inflation. And when this real, when I say real now, it is exclusive of inflation. When you add the inflation, what you get is nominal rate of return. Simple. So risk free means what? What you earn on the government securities. Real means what? Inflation is not, means you have not taken into consideration. Is that clear? Understood? Next. So as I said, this real risk free rate now is the real interest rate. This is what? Real interest rate. Okay. That real interest rate which is not adjusted for inflation. Understand the words. See the words what I am saying. Real risk free rate is what? Not adjusted for inflation. What is nominal? The interest rate which is adjusted for inflation. Means inflation is added. Simple. Real means no without inflation and nominal means real plus inflation. Okay. This is called as Fisher's equation. Okay. We'll come to that in economics. Now, see, obviously, as I gave you this example, okay, there is a time preference concept in economics and also in finance that says that excuse, generally the people now they prefer sooner rather than later. People want everything today. They don't prefer. So there is something called as time preference. Everyone, if I ask you, you want something, let's say iPad Pro, when you want, today or 1 year later, you will say today. That is called time preference. Okay. So there's a concept in economics or in finance, let's say. So basically, there is a thing what we call as time preference. Means people always they believe, no, I want it today rather than tomorrow or later. Okay. Coming to the next part, inflation. Now let us understand this. Inflation. Now what do you mean by inflation? Inflation means purchasing power. Increasing inflation premium means what? Purchasing power. Okay. So inflation premium, which is also known as inflation risk premium also. What we call? Inflation risk premium. Every investor, he demands or he wants the compensation for uncertainty. Uncertainty means what? He believes that there can be a potential loss in the purchasing power that is caused by the inflation. Like I said, I gave you the example. Today you can buy it 100 at 100. But let's say if you are expecting an inflation of 10% and if it is 110, correct now? So if the inflation goes to 110, that means what? I will have to buy it at a more price. Therefore, in the interest, I will include what? Inflation premium. I want that. I will love to have that. Correct now. What is the point? If you are investing 100 and you are going to get 106 and inflation you are expecting at 100, and that means you are at a loss. You will have to buy the same product which you could have bought today at 100. You will have to pay 110 after 1 year. And what the investment you have done na 100, instead of buying this, instead of buying today, you have made an investment at 106. That means this extra 4 you will have to pay from the pocket. Therefore, always na people prefer that they should get the inflation premium, and therefore our formula becomes, this is Fisher's equation. Okay, therefore the formula, the actual formula na, not this is not the actual formula. Actual formula is, see, just adding something to the knowledge. Whenever you add something na, whenever you add na equals to add, since you're adding, it is called additive model. You are adding, but this is not actually additive model, it is multiplicative model. Multiplicative model means what? To the nominal rate, in the left side if you see above, I wrote nominal rate, real risk free rate plus inflation premium. For MCQs this is okay. For MCQ, to solve the MCQ, this is okay, fine. But to get the exact answer, it is something like this: 1 plus nominal rate is equals to 1 plus real risk free rate, okay, into 1 plus inflation premium. See here, there is a multiplication. It's not a additive model. Actually, this is called as Fisher's equation. This is called what? Fisher's equation. Let us make it simple. Let's take an example. Be ready with your calculus. Okay. So let's say my real risk free rate is 4%. My inflation premium is 3%. Correct. So if I ask you now, roughly my nominal rate should be 4 plus 3 is equals to 7%. But it is not exactly the 7%. Okay. This is approx answer. Nearby 7%. Then what it is? We'll apply this formula. 1 plus nominal rate is equals to 1 plus real risk rate 0.04. You will take this in decimal into 1 plus inflation premium is 3%. So 0.03. Just check the answer. Give me the answer, please. Yes. What is the answer? Anyone? What it is? Should be more than I think. Yes, correct. 1.0712. Correct. So 1 plus nominal rate. See, it is nearby 7, but it is not exactly 7. So to solve the MCQs now, if the MCQs means everything, means if you in the exam you get an option 5%, 6%, 7%, 8%, then obviously you can mark 7 directly the answer. Whatever is with respect to 7. But if everything is 7 now, then you'll have to calculate the exact answer. You understand what I'm saying? The option are very far than 7. Then easily you can mark whatever the 7 the answer is given, that one. Okay, 7 point something. 1.0712 minus 1 will become 0.0712. This one I will take it on the right side. Okay, so it is 7.12%. So my nominal rate is 7.12%. What we learned here? Multiplicative monoid. This is called Fisher's equation. Irving Fisher, okay, economist, he gave this. This by this formula now you can get, means additive. By additive, by adding, you can get the approx answer, but by multiplication you can get the exact answer. This is the exact one. Okay, fine. I have given this all this thing in the notes. You can refer this. Fine. Okay. To correct this, I want to add something. I was calling this nominal rate, but this is nominal risk-free rate. Nominal risk-free rate. Okay. This is nominal risk-free rate. So real risk-free rate plus inflation premium gives you nominal risk-free rate. Fine. Now moving ahead. These are not the only components of interest. Interest, okay, to rectify, okay, to make it more clear, interest means what I'm talking about is nominal rate of interest. What? Not nominal risk free, nominal rate of interest. Nominal interest rate of interest is made up of real risk free rate, inflation premium. So when I add this, I get nominal risk free rate. Just now what we have seen. If I add this, I'll get nominal risk free rate. Correct? But here I'm talking about nominal rate of return. Okay, don't get confused. So plus what? Plus default risk premium. Then you have liquidity risk premium. Liquidity risk premium. And the last one is maturity risk premium. Write it nice. Liquidity. Now there are three types of risk. One is default risk, another one is liquidity risk, and third one is maturity risk. Okay. What are these three risks? Okay. These three plus the nominal risk rate, when you take together, it is called as nominal rate of interest. What we call? Nominal rate of interest. Fine. So understand, guys. You took 5,000 from me, but I think if in case after 5 years you are unable to pay me, understood? You are unable to pay me, then that means there is a chance that you can default. And because that risk is there, okay, in that interest rate, one component will be default risk premium. If there are more chances of you to default, the default risk premium will be more. If I believe in you and I think that you will not default, the default risk premium will be less. Very easy. Default means what? The chances that you will not be able to recover your money. Okay. I hope it is clear. Next is liquidity risk. What do you mean by liquidity risk? Liquidity means you have some investment. Okay. When you go to the market now and you try to sell it, you're not getting the price at which you wanted to sell. Means you are not getting the fair value. Means you immediately quickly cannot sell it and make the cash. Understand? I want to sell something. Okay. And because I wanted to sell something, and when I went to the market, I'm not getting the fair value, I'm unable to convert that investment into the cash, is known as liquidity risk. Whenever the investments immediately cannot be converted into the cash, that is known as liquidity risk. That is liquid risk. I believe that whatever the investments I'm making, okay, I will not be able to convert immediately into the cash. The market is illiquid. What we call? The market is illiquid means buyers are not available in the market. That is known as liquidity. And because I have that risk, therefore I charge what? In the interest I will charge liquidity risk free. The last one is maturity risk. Okay. What is maturity risk? Now understand. If there is an investment for 10 years and there is an investment for 5 years. Okay. Understand, very simple. See, whatever we think now means our vision in the sense After 10 years, what will happen, you also don't know, right? But near future, now we can easily make a guess. Within 3 years, this thing will happen. Within 5 years, this thing will happen. Correct? But when it comes to longer period, now longer period means your investment is going to mature here. So more is the maturity, longer the period, you will charge, there is longer, you will charge maturity risk premium. What you will charge? Maturity risk premium. Why? Because 10 years is more uncertain than 5 years. 5 years, 2 years, you can make a guess. In 2 years, nothing will much will change. But 10 years, you never know now whether the company, whether the investment will go bankrupt or something. So because the maturity period is longer, you will have more maturity risk free as compared to shorter maturity investment. Longer the investments, more is the maturity risk. Shorter the investments, less is the maturity risk. Is that clear? So let's summarize. So we have completed with the LOS 1. Nominal, I am repeating, this was nominal risk free rate. Okay, correct this if you have written somewhere. Nominal risk free rate is made up of real risk free rate and inflation premium. Okay, when you add this nominal risk free rate with default, liquidity, maturity, you get what? Nominal rate of. Fine. So this is a LOS 1. Yes. So there is some lighting issues today. Okay, but I think it should get corrected in the next class. But the show must go on. That is true. Let's move ahead. Calculate and interpret the approaches to return of measurement over and describe their appropriate uses. Means, what are the different return measurements? Very simple. We have already done this. Okay. So we have seen all these things, but we will practice this on our financial calculator. Okay. So the second LOS is easy and their uses. Okay. When to use what? We have already learned arithmetic means, geometric means, harmonic. We have not learned also. It is quite easy. So generally, see the first very easy one, okay, return, what we calculate or what we use in finance is known as holding period return. What do we call? Holding period return. Okay. Now, what do you mean by holding period return? What I have earned over a period, okay, when I was holding the investment. In short, let's take one example. I bought one stock. I bought one TC. Let's say I bought at 2023. The price was 2590. 2024, okay, I sold it at 3500. And let's say I got a dividend in the 2023, okay, of let's say 50. Fine. So how I will calculate my return? See, I got 50 rupees as in earnings, dividend, plus extra what I earned. I will sell it at 3500. I bought it at 2590 divided by the price at what I bought into 100. Correct? So basically what I'm doing is dividend plus change in price divided by base price into 100. Generally, this one, no, this dividend is called as div. Just a notation, div, division at the t time. Fine. This 3500 is called as pt. What do we call? pt, and this is called p0, means what you bought. So if I want to write a formula, what I will write is, I can write it like this: divt plus dividend plus pt minus p0 upon p0 into 100. Let's make it simple. See, the easier way to calculate this is what? Means one way to calculate this is what? This you should understand, very important. 50 plus the change is how much? 50 plus, okay, please Give me this figure. 3500 minus 2950. 3500 minus 2950. I think 550. So I will write 550 upon, correct now? What happened? 2590 minus 3500. I mean 3500 minus. Okay, it's wrong. So what's the answer then? I was checking whether you people are paying attention or. Nice idea, na? 910. The difference in the price is what? 910. Upon what? 2590. And then I do into 100. So what is my answer? 910 plus 50 divided by 2590 into 100. So my return is how much? 37.06%, 07%. Fine. Okay. So basically this is what? Holding period. Because I holded this, okay, investment, I bought it at this price, I sold it at this price. Okay, my dividend was this. So my total earnings now, this is my total earnings 960, and I invested how much? 2590 into 100. So this is my return, holding period return. So this is the formula which is given in the text also, okay, with the example. Fine. The easiest way to do this, you know guys, what it is, I can modify this formula like this: 3500, that is PT, plus 50 divided by 2590 minus 1 into 100. You'll get the same answer. Check. Please check. What I did, PT plus dividend means this is my total inflow, this is my outflow. Okay, 2590. Think like this. This is my inflow, all inflow, correct? Divided by outflow, minus 1 into 100. What is the answer? Check. 3500. Same now. I'm also checking. Correct. 37.07%. One and the same. Yes or no? Same it is. So means what I mean to say is this formula can also be written as division for t time plus pt upon p0 minus 1 into 100. This is the best way to calculate, I think. As a CFA student, we should know this. Fine. Many times you have to calculate, and this becomes easy because of this. Means you will take the change and then you will add the dividend. It becomes a bit lengthy. I think this you should know. Dividend plus price, okay, at the end upon P0, the purchase price, minus 1 into 100. Is this clear? Okay. So don't get confused. Let us make this more simple. I can write it D1 plus P1 upon P0 minus 1 into 100. Okay. If you want, you can take the screenshot of this one formula. This also you can take the screenshot, okay, picture, and at the same time, this also you can take. Okay, fine. Is it clear? Fine. So the same thing. This is called what? Holding period return. What we call? Holding period return. Fine. Moving ahead, three type of means are there. Okay. Averages, three types: arithmetic mean, geometric mean, harmonic mean. Fine. What is arithmetic mean? Generally, arithmetic mean is simple average. Very simple. What is the formula? Let's say I tell you that 2020 I had 15% profit. 2021 I had 18% profit. 2022 I had 17% profit. 2023 I had 20% profit. What I will do? What is the average profit? I'll add, divide by 4. Correct. So what is the formula for arithmetic mean? Return 1 plus return 2 plus return 3, like this till nth term upon n, means number of returns. Correct now? Is arithmetic mean. Correct. Now generally, statistics wise, means we will do it further also, but just I'm adding one point. Arithmetic mean na, it has all the qualities what a mean should have. Fine, I'm just giving you a hint of preparing your base for the chapter where we are going to head at the end. So arithmetic mean is nothing but it has all the qualities. Only one bad quality it has. What you know? It gets pulled by the extreme value. It gets pulled by the extreme value. Whatever features a mean should have, it has everything. It is unambiguously defined. Unambiguously defined means what? You get only, whenever you calculate arithmetic mean, you get only one value, right? But when, let's say, if let's say your company has a return of, now here I don't know, just check what is the percentage. Give me the figure. Use the calci. I'll show you my calci also. Right? Meanwhile, can you see my calci? Has come. 15 plus 18 plus 17 plus 20. Many calculus now they have a problem. Means normally we have a habit. In normal calculus, what we do, we directly press divide. But some of the calculus you have to press here equals to. See, when I press equals to, it gives me the total. Okay, why it is not working? 15 plus 18 plus 17 plus 20 and then equals to. Is that clear? 70 divided by what? 4. So my average is 17.5%. Is that clear? What I was saying is, so I'll show you. 15 plus 18 plus 17 plus 20 divided by 4. I will not get the answer. So I'm getting 55. Understood what I'm saying? So you have to check your calculus settings. Okay, fine. Means here you have to press equals to at all these steps. Be careful with this. Be comfortable with your calculus and all. Now listen, what I was saying, coming back to the point. Let's say in 2024 I have a profit of 78%. Now see, this 17.5 now is nearby all this values whatever I have on the screen. Oh, 1 minute, I was writing and calculus in between. So this 17.5 now as is average of all this 15, 18. It's nearby. What is 17.5? Is the value which is representative of all the returns what you have earned. 17.5 is representative. There's nothing wrong to say like that. Okay, so mean should be representative, means it should be the central value of all the values what you are considering, correct? Now what happens in the same calculation? See, I include 78. That is an outlier. That is an extreme value. Now what happens? See, 15 plus 18 plus 17 plus 20 plus 78 equals to, I'm getting total 148. Divide by 5 this time. 148 is the total. Divided by 5. Answer is what? 29.6. Means it jumped directly. Because of what? Because of this extreme value. So this is the only one drawback which we'll cover later also when we'll start with statistics part. But this is the only one drawback what the arithmetic mean has. Otherwise it is very good. Okay. Otherwise arithmetic mean is true. Means it's a very good what I should say. It has all the statistical properties I should say. Okay. And it's an one of the best mean what you have. Fine. So this was simple. Okay. So one property we have learned, that it gets pulled by the arithmetic extreme value. Now that is the only one drawback. Next is geometric mean. Now what is geometric mean? We will solve questions on this, don't worry. Okay. Geometric mean is what? It's nothing but whenever you are calculating something based on compounding, now we use this. Means whenever there is a percentage involved, a compounding rate, whenever you have to calculate the thing, the return based on compounding, at that time we use geometric mean. Means what? Let's say if I tell you 17%, now if you check the same data, 15%, 18%, 17%, 20%. 15%, same, 18%, 17%, 20%. Now when the thing is like this, now year on year basis, compounding you have to calculate. Compounded return, at that time we will use geometric return, geometric mean. How we do this? Very simple. Now what I do is, I'll write the formula later. 1.15, 1.18, 1.17, 1.20. I hope it is clear. 15% is 0.15 plus 1. So I've converted the percentage into decimal. I've added 1. Okay, and this the whole power to 1 by 4. Why? Because there are 4 numbers, and then I will minus 1, which I added earlier. Okay, if you check this, see how to solve. I'll open my calci here. See, it was 1.15 into 1.18 into 1.17 into 1.2, okay, is equals to, see, I'm getting this part I am getting as 1.9052. Correct. Now how to do this? Raised to 1 by 4. If you check here, there is a button y raised to x. Check here, y raised to x. In this line, see, y raised to x. I have pressed it. See, y raised to x, y raised to x. Correct. Bracket open, y raised to x, then bracket open. Okay, I have pressed bracket open. See a bracket open here. 1 divided by 4, bracket close. See 0.25, I can see that, equals to, now this is my answer. 1.1749 minus 1 is 17, 0.1749 is 17.49%. What I did, I multiplied this, I got this. There is a button called as y raised to x. I pressed bracket open, 1 divided by 4, bracket close, okay, equals to. Is that clear? Understood? Please follow these steps. Please follow these steps. Above 9, you have y raised to x. That is the power. Whenever you have to give some power, you will use this. Okay, fine. Understood? Easy enough. Please try. Please try at your own. I think everybody should get this answer. Fine. When you multiply this part, you get 1.9052. You press y raised to x because I want to give the power 1 by 4. How I will give it? Bracket open, 1 divided by 4, and then equals to I will press, and then minus 1. Okay, I should get this answer. Okay, that's simple. Fine. So this is how you calculate what the geometric mean. If you see my arithmetic mean was 17.5, my this is 17.49, correct? Slightly lower. Actually, it should have been more lower, but your geometric mean is always less than what? Arithmetic mean. In short, arithmetic mean is greater than geometric mean. Fine. Always. This is one of the properties which you should remember. Okay. Or geometric mean is always less than, or we can say that arithmetic mean is greater than geometric mean. Now the last one, what it is? Harmonic mean. So I think we'll stop here. Okay. We'll continue in the next class. Fine. Thank you. Because harmonic mean I need to cover it means very nicely. There is something very good concept is there. I need to cover that. Okay, we'll stop here. Thank you so much. If you have any doubts, please let me know. Okay, you can WhatsApp me on the number what you can see. Okay, at the same time, you can join the Telegram channel also. Okay, is there which all we have all CFA students that. Okay, it's the name of FinHub Academy. Okay. In the YouTube channel, be careful that you type full name FinHub Academy because there is some more channels also with the name of. Be careful with. Okay, thank you so much. Let's move to the next part, that is harmonic mean. Now, what do you mean by harmonic mean? Let us see the formula for the harmonic mean. It is the formula na what we give is n upon summation of 1 upon x. Now, actually, what we are doing is we are not taking x, we are taking the reciprocal of the x. Okay. Now, what happens? Arithmetic mean and geometric mean has a specific, means they are generally used, but harmonic mean is a specifically used where ratio or the percentage is involved. Wherever the ratio is involved, there we calculate the harmonic mean. Okay, why? I will tell you this. Okay. Now what happens? Listen. Let's take one example so that we can understand this better. Okay, and we will prove this also. Okay. Just for the sake, means those who just for I'm diverting from the topic. See, when we calculate the speed, now it is distance upon time. Understood? So let's say you have two speeds given for the same distance. Understand this. Distance is same. you go from A to B at 100 kilometer per hour, and you come back from B to A at 120 kilometer per hour. Now the distance is constant between the place. In this case, now if I ask you that what is the average speed overall of the journey, you tell me 100 plus 120 divided by 2, that is simple average, the answer would be wrong. This is ratio, and since the numerator is constant, you should apply harmonic mean. Let us understand this with the help of, I am just telling you the means, as I said, harmonic mean has a specific use. Arithmetic mean is used simple, means simple average, just you have to calculate an average, everywhere you can apply. Geometric mean, generally when the percentage compounding is there, na, at that time you apply. And harmonic mean, when the ratios are involved, na, at that time you apply. So let us take one example. So there is a specific use, what I mean to say, okay. So let's say $100 you invest, correct? Every month you invest $100, fine. Now what happens? The stock which you are trying to buy, the price will keep on changing, but you're buying the same stock. So 100 first month, second month again $100 you invest, third month again $100 you invest, fourth month again $100 you invest. Okay, let's say the price is 20, fine. Let's say the price increases to 25. Third month, let's say the price increases to, let's say decrease to 18, then again 30, right? You invested $100, per stock price is 20. So how many stocks you will get? 5. How many stocks you will get here? 4. How many stocks you will get? Just give me the decimal, please check. 100 divided by 18. 1 minute. Yes, what is the answer? Yes. Let me check. Yeah, please tell now. The 100 divided by 18. Fine. 5.55. 56. 56 we will take. Okay. 56. And the next one, 100 divided by 30. Ah, correct. There also. Yeah. Right. 3.33. Let's check 3.33. This is 5.56. So you understand, overall now I invested 100, 100, 100, 100. Correct? See the logic. 100 I invested. So total investment is how much? 100. Correct? How many stocks I got? 5 plus 4 plus 5.56 plus 3.33. Give me the total. Total number of stocks, 5 plus 4. Yes, plus 5.56. Correct? Plus 3.33. 17.89. So total number of stocks is how much? 17.89. So what is the average price? 400 I invested. What is the average price? 17.89. What is the average price? Check. 400 divided by 17.89. 22.3358 means 36. Means approximately this is the price. Average price of each stock. Correct? But friends, if you take, if I ask you what is the average price, and if you take the simple average of this now, it will not match with this. Check whether you are getting. Check 20 plus 25 plus, I am also checking, plus 18 plus 30. Total comes to 93. Okay, divide by 4. 23.25. This is arithmetic mean. Simple average. So arithmetic mean, how much you are getting? 23.25. Correct? While harmonic mean is what? 22.36. I'll prove this. Average, so we will calculate like this only now. $100, $100, $100. Total I invested 400. This is the number of stocks what I have. So what is the average price at what I got that? 22.36. So this one is wrong. Arithmetic mean is not matching. Let us check with harmonic mean. Okay. So how many values I have? 4. Therefore the numerator is 4. 1 divided by 20, first one was 20, plus 1 divided by 25, plus 1 divided by 18, plus 1 divided by 30. Now how you should calculate, you know? Listen, in your calci, there is one above, now above 9, you have y by x, and above that you have 1 by x. Okay, so if you press 20, 1 by x, it will automatically be 0.05, means you will get 1 by 20. Reciprocal 20, or otherwise you can press 1 divided by 20, but 20 1x 1 by x, if you press, you get 0.05. Okay, 20 1 by x, above 9, now above 9 you have y raised to x button, above that you have 1 by x button. Okay, if you press this, you will get the reciprocal. Okay, plus I think 25 1 by x equals to, plus 25 1 by x equals to, plus 18 1 by x equals to, plus 30 1 by x equals to, fine, I am getting 0.1789. When I take this total now, I am getting 0.1789. Go slow. 20 1 by x equals to, okay, 20 1 by x plus 21 by x plus 25 1 by x plus, okay, 18 1 by x plus, and 30 1 by x plus. So I am getting this denominator as this, correct? Now you can store this. There is one button on the left hand side. Let me show it to you. See this button, STO. See, I am pressing STO. You can put this on STO1, means it will get stored in 1. Okay, STO1. Okay, then 4 divide RCL. See here, RCL above CC, RCL left hand side, then equals to, oh, I did not press, fine, 1 minute. 4 divide RCL1. Okay, see, RCL1 is getting reflected, is equals 22.36. See the answer. What is the key? I stored this in 1, STO1 I have pressed. You can see on the left hand side STO1, correct? Beside the 4 you have STO store, and then 4 divide, to recall I will press RCL1. I will get, it will show me this figure. Okay, is that clear? And then I press equals to, I'll get the answer 22.36, is same as what we got under what, here, under normal common sense, correct? The 1 minute, the common sense was what, the common thing was this, the common thing was what, the common sense logic says that average price should be 22.36, and here in under harmonic mean also I am getting the same answer. That means harmonic mean now is the best measure. Why? The reason being that, because wherever the rate is involved, there if you calculate, understood, wherever the rate is involved and the numerator is constant, now numerator is constant. See, 100 numerator was constant everywhere, 100 I'm trying to calculate the ratio, how many stocks I got, how many stocks I got, how many stocks I got. I got 5 stocks, then 4 stocks, then 5.56. The numerator was constant. Wherever the rate is involved, you should use what? Harmonic mean. Very specific uses we have of the harmonic mean. Okay, so I think this example, I'll give it in the book. Fine. Okay, now let's move to the next part. So next mean is trimmed mean, or what we call, one more is there. It is very much similar. Okay, Winsorized mean. Okay, both are very similar, but let me explain you. Now trimmed means what? Trimming. Trimming means cutting the data. Okay, so what happens if there is full data set now? Okay, what you do is, the this lower 5% data and the highest 5% data you remove, and then you calculate the average for the remaining thing. That is called what? Trimmed mean. Certain set percentage of there, not always 5%. You can, from the lower part, means lower, means when you arrange the data, the lower 10% you can remove, above 10 means higher 10% you can remove. The remaining data you consider from the data set, and then you calculate the arithmetic mean for that. That is known as what? Trimmed mean. Okay, we don't have anyways the formulas and all this for this. Okay, because I don't think that they are more concentrating on the formulas. They have just given you what is trimmed mean. Is that clear? Fine. Now listen, same way, there is something called as vincerized mean. Vincerized mean means what? Instead of removing the percentage of data, what we do is we divide the data in percentile, means 100 parts, 99 parts, and then let's say fifth percentile data, this lower 5 percentile data, fifth percentile data, or the above 95th percentile data. Okay, how to calculate the percentile, that also we will learn later. Fine, the lower fifth percentile data, the values which are below fifth percentile and which is above fifth percentile, these extreme values are replaced by lower numbers. What I said, are replaced by the lower numbers. I can't give you example, and anyways the example has not been discussed. It is not going to, they will ask you only, since they can ask you directly what does it mean. Is that clear? So I'm not going into the numbers. I calculate the fifth percentile, 95th percentile, whatever the below the fifth percentile, whatever the data is there, this values now, means the lower values now, they will replace these values, understood, with less extreme values. As you, if you remember, when I discussed the arithmetic mean, I said that arithmetic mean gets affected by the extreme values. So what they do, this lower values now, if they are very much extreme, they will replace it with the data's, the numbers which you have here at the center. Is that clear? Same way here also, whatever is here now, 95th, above 95th percentile, those datas, okay, they will replace, those extreme values will be replaced by what the numbers you have here. Is that clear? So whatever was the drawback of arithmetic mean, that it was getting pulled by the extreme value, that will get sorted. Understood? So here we calculate the percentile. How to calculate the percentile later part, we will see that. Okay, so you have to remember that, for example, fifth percentile, below fifth percentile, whatever the data is there, they will be removed and they will be replaced by the nearby values. Means whatever the values you have now, means extreme values will be removed. Okay, and it will made it, the data what you have here in the center, in the body of the data, whatever the values more often is there, okay, near to that, all the values will be replaced. Means let's say here, in case here you have let's say 10 is there, but extreme value I'm saying, but here all you have 40, 45, 35. So what you will do is you will remove this 10 which is very much extreme, and you might put 30 or 35, something like this, nearer to that. Okay, that is the only thing. Fine. So here we complete all the means. Arithmetic mean is done, correct. Geometric mean is done, harmonic mean is done, okay, and then we did trimmed or inserized mean. Okay, fine. Going ahead, let's see what next. Okay, so I think we'll have to go back to LOS. Yes, so their appropriate uses also we have seen. Fine. Obviously trimmed and vincerized when you will use, when there are extreme values in the data, correct. That is the only purpose. Fine. Okay, since it will decrease the outliers. Extreme values are called what? Outliers. So we'll decrease the outliers. Fine. Okay, calculate the money weighted return and time weighted return. Now these are two important things. Okay, and evaluate the performance of the portfolios based on this measures. Okay, so why it is important? Because what happens, this is very much important, and we should know this also, hence how to calculate, because it is applicable very much everywhere. Fine. So some basic knowledge is required for this. Okay, what is that basic knowledge? We should know how to calculate the present values. Fine. So I'm going into that now. Okay, how to calculate, let us club this chapter, and let us learn something from the next chapter also, and let us proceed with that. Okay, now listen. Now what happens, on my calci, like I gave you one example. Okay, and we are going to calculate also this time. Fine. I will open the cash flows. Let me write one example that you can understand. I'll open up this example. Okay, the first year end, I have 1000. The second year end, I have 1000. The third year I have 30,000. This is a previous example what I have taken. 40,000. fifth year I have, and I think the investment what I took in my example in the previously was 50,000. Okay. So let's say my discounting factor, okay, discount rate is 10%. Fine. Now guys, one way to calculate this is how we calculate the present value. I want the present value. EV means present value. Value is today's value. This 10,000 is standing at the first year. Very simple. What I will do is I'll go to show you the second line. What you can see, this second, see this line, second line, okay, and there's a third line where n is there. This is time value line. This whole line na, is time value. This whole line is time value. Okay, thinking. Fine. So now what I can do is I want to calculate the present value. Now this 10,000 is standing at first year end. So at this future value. So I will press 10,000. Then I will press FV. Press 10,000 and then press FV. Correct. My n is 1. So 1 n. 10 I by y. 1 n. Then 10 I by y. Then I will compute. See, compute is here. The first button on the calci below the screen. Compute CPT. Compute PV. So my answer is 9090. This is my present. Is that clear? Understood? So what I did is one more time. Okay, there is n, there is I by y, and there is PV, there is PMT. For the time being, PMT is of no use. This is standing in the future. Okay, this is standing in the future. Fine. What I will press is 10,000 FV. First I will press this. My 1 year back I have to pull, so my n is 1. 1 n I will press. Discount rate is 10%, so 10 I by y I'll press, and then I will press compute PV. What I get the answer is this. Is that clear? Now this is a series of cash flow. So to do this, okay, I have the cash flow. That is the second row. This one, see this second row. You see this cash flow. CF means cash flow. I'll go into the cash flow. Okay, CF0 means 0th year cash flow. When I press the down arrow key, see here, there is a down arrow key. Here, up, down, up, down, up, down. C01 means first year cash flow. Okay, I will press 10,000. I will press enter. Okay, 10,000. Then I will press enter. Down arrow key, down arrow key. Then I will press 20,000. Enter. Down arrow key, down arrow key. 30,000. Enter. Down arrow key, down arrow key. 40,000. Enter. Down arrow key, down arrow key. 50,000. Enter. Okay, and then just feed this 10,000 in the one. How I will feed? I'll press CF cash flow. C0 cash. C0 0 is nothing. I'll press down arrow. Okay, I'll get C01. That is 10,000. I'll press 10,000. C01, and then I will press enter. Down arrow key. Down arrow key. C0 to 20,000. Down arrow key. Sorry, enter. Then down arrow key. Down arrow key. C03 3000. Enter. Down arrow key. Down arrow key. C04 40,000. Enter. Down arrow key. Down arrow key. C05 50,000. Enter. Down arrow key. Down arrow key. Is that clear? Understood. Once I press this, then if you see the second NPV button, if you press NPV, okay, it will ask I. Then I'll press NPV, means net present value. It will ask I. How much is I? I was 10% interest rate. I will press 10. What I'll press? 10. Enter. 10. Enter. Press enter. Okay. Once you press enter, okay, then you have to press down arrow key. What you will see is NPV. What you will see? NPV. You will press compute, CPT, compute. So answer is what? 1,06,525. Now let us analyze this. If you have done with this, if you have any problem, slow down, okay, pause and check what we have done. Fine. Go through this, should be easy for you. Okay, once I press the whole data, I will press NPV. On the screen, I will get I is equals to, I'll press 10, enter, and then I'll press down arrow key. I'll press NPV, compute. I think if I press down arrow key, I'll get NPV, and then I'll press compute. Correct it is. Okay. Oh, fine. Be comfortable with the calculation. Let us understand the concept. No worries. We will dig into this. Okay. We'll dig into this in the next chapter in the capital budgeting, corporate issuer. Everywhere we'll be doing this the same. This valuation should be very important to know the valuation. Fine. Everybody comfortable? Let's move. Listen, I want to discuss something. Now, guys, see, understand the concept. If this is my required rate of return, these cash flows which I'm going to get, the value of that in today's term, present value, the value of that is 1,06,525. Whatever the cash flows I'm going to get now, I pulled it back, I calculated the present value. According to me, the value is 1,06,525. Understood? In case if I am spending for that product, according to my example, if you remember, I took here outflow as 50,000. Previously, when we were doing now, I was showing you, let me show it to you. 50,000. See here. What I have taken? Outflow as 50,000. See, check. Correct. Same I am saying. Means here if my outflow is 50,000, means I am spending 50,000, but the worth of that is 1,06,525. Good or bad? Good. Good or bad? Good. Correct. All this now, all this were inflows. I calculated the present value of the inflows. Correct. These are inflows. I calculated the present value of inflow, so I can call this as present value of cash inflow. 50,000 I am spending. 50,000 I am spending. Understood? 50,000 is present value at today's point. 50,000 today I will spend. So it is present value of cash outflow. Correct? When I calculate the difference of this now, present value of cash inflow, present value of cash outflow, what I get is net present value. What I get is net present value. Give me the answer, please. 56, 525. 56, 525, right? 56, 525. This is my N. Okay. See, is it clear? I repeat one more time. 10,000, 20,000, 30,000 were inflows. I will get. I calculated the present value of that. So the total of that is called as present value of cash inflow. Present value of cash outflow. Today what I will spend is 50,000. Correct? So this is net present value. One is inflow, another one is outflow. When I minus this, what I get is net present value. If the net present value is positive, it's good. Anyone can understand. See, the value of what I'm going to get is 1,06,000. What I'm spending, the present value, 50,000. So the thing which is valued at 1,06,000, you are spending for that only 50,000. Therefore, it is worthwhile. Simple thing. Why we can compare these two things? Because both are present value, means at same point of time. They are not at different point of time. This is the game of time value of or basics of financial mathematics, the next chapter. Now, guys, what we did here was the first one. Now, when I calculated, it was very simple thing. What I did, I took this, I used this strokes. Correct? This strokes. Same way for the second one. Now I can put n as 2. Again, I by y will be 10. I will put FV as 20,000, and again if I compute the PV, I will get the next figure. Same way I can get the next figure. Same way I can get the next figure. Same way I can get the next figure. And when I will take the total, this inflows present value will be same as this, what you got here. Exactly, you can try this. Okay. So it will be same. Fine. Both ways you can do. But since we have that convenience of using the cash flow, therefore we can do it very easily. That clear? So now guys, what I mean to say is, please understand, I'm erasing this, or let me write it one more time. Let's say year, cash flow, discounting factor, and 1, 2, 3, 5. Here it was 10%. It is 10,000, 30,000, 1,000, 40,000, 1,000. And this total now was coming as 1,06,525. This was my PVCI. Then I deducted PVCO, that is 50,000. I got what? 56,525 as N. See, when I discounted this now, you'll understand why I'm saying all this story. Okay. See, when I discount this at 10% now, I got something value here, right? Okay. At 10%, I got something value. Can I change this rate in such a way that this PVCI should be 50,000? I will change the rate, this rate and this rate. I will change this rate. I will change this rate. I will change this rate in such a way that PVCI will be 50. My PVCO is already 50 and my NPV would be 0. Can I get that rate? Yes, I can. And that discounting rate now, when I use that discounting rate here, when I use this discounting rate, okay, that rate where the NPV is 0, that rate is known as IRR. That rate is known as IRR. It is internal rate of return. Is what? Internal rate of return. One more return has come. One more type of return. I repeat, please don't get confused. What I'm saying is, in NPV, while calculating, the discount rate was given. At that discount rate, I got 1,06,525. I got the NPV positive. I want to make the NPV 0. Okay, what is the rate at where the NPV is 0 is known as IRR. Now, if you open your Calci, take your Calci, I think the data is already there. Okay, I think so. Data is already there. So let me check. Yes. See here beside NPV, I have IRR. See, I have pressed the IRR and then I will press compute. Oh, yeah. 1 minute. Because I have not fed the outflow now, therefore it is showing me error 5. So again, I will go to cash flow button. Okay, coming out cash flow, the data is already there, 10,000, 20,000. Yes, everything is there. See this C01, na, C00, CF0. I'll press here 50,000 because this is my outflow, 50,000, and this beside equals, there is plus minus sign. Okay, this one. See, this is plus minus sign. So once you press, you will get minus sign, and then I'll press enter. Now outflow is also put. Now I will press IRR and then I will press compute. So the rate is 38.16%. How much? 38.16. So at 38.16%, my NPV is 0, and also I can say PVCI is equals to PVCO. PVCI is equals to PVCO. I hope it is clear. Please give me a thumbs up, guys. Yes, everyone. Is it clear? Wow. Very good. So this IRR, my dear friends, IRR we call this, okay, IRR, see the names, very simple, don't get confused. IRR is also called money weighted return. What we call? Money weighted return. Money weighted return. Or it is also called dollar weighted return. Dollar weighted return. Is this clear? Actually, this return now, it measures the performance of an investment. It takes into account the timings of the cash flow. If you see the example, I have taken the major cash flows at the end. Understood? Fine. So here means very well it should be understood that inflow as well as outflow, both's impact is considered by money weighted return, that is IRR. And at IRR, PVCI is equals to what? PVCO. They can ask you question. At IRR, NPV is what? That clear? Understood? The very best example. Fine. There is one more return which is also used to evaluate the performance of the investment portfolio, where the inflows and outflows are not considered. Purely there, what is it is on based on what? Performance. Performance, how you measure the performance? Return. Therefore, the formula of that is also based on return, and it is called time weighted return. I said in IRR, it also considers the cash flow. See how you calculate, simple to remember. How you calculated IRR? Using the cash flows. Therefore, it takes into account cash flows. But there is one more return, that is time weighted return. What I said? Time weighted return. And this is purely based on return. That is HPR, holding period return we calculated now. The formula is what? 1 plus HPR, that is first year return, holding period return, into 1 plus HPR, second year return. Understood? Like this, 1 plus HPRN, understood, minus 1. Are you understanding this? Is this clear? Okay. So what we try to do here is very simple. What we try to do here is very simple. If I know the returns, I take that in decimal. I add 1. Understood? Means in short, have we done this? Have we done this anywhere? Anywhere have we done this? Have we done something like this? Have we done? Yes, there. Okay, where we have done. Yes. Here I will write 1 by n, correct? It is geometric mean. So wherever there is a compounding growth, now this is nothing but geometric mean. What we are calculating? Geometric mean. Is that clear? Geometric mean. Please be careful. Same thing is going on, only the name has changed. Fine. So let us take one example. Okay. Let's take one example. Okay. On time value of money. So let's say there is one period. Okay. Period 1. And there your initial investment is $10,000. Let fine. Ending value of the investment is $11,000. What is your holding period return? If I ask you, your gain is 1,000 divided by 10,000, right, into 100. So can I say it is 10%? Yes or no? 0.1 or 10%? Right. Period 2, there is no additional investment or withdrawal. Okay. Your ending value in period 2, let's say $13,000. Correct? You understand? Please, there is no additional withdrawal or anything. Correct? So my ending value is not 12,000. Okay. If let's say it is 12,000, then understand 12,000, I started with 11. My beginning value was 11. So 12,000, correct? 12,000 minus 11,000, that is 1,000 is the gain. 200. Please understand this. My ending value was 11. I'll start with 11. See, it is compounding every year. Correct? And ending value in the period 2 is 12,000. So my return will be how much? Don't tell me. 9.09%. Very good. Now period 3, let's say. Again, no additional withdrawal, investment or withdrawal. Okay. So ending value, let's say, is $13,000. Fine. My beginning value is 12 and ending value is 13. So 13,000 minus 12,000 upon 12,000, 200. Answer is how much? 8%. Fine. So how I will calculate time weighted return? Listen, overall for the period, now how I will calculate? I will not take the root. I will directly calculate 1.1. Correct? 1.1, that is 10%. Fine. Into 1.0909 into 1.08 and then minus 1. Just check the answer. Multiply this. How much you are getting? 1.1 into 1.0909 into 1.0833. I'm getting approximately 1.2999 minus 1 means how much? 30% approximately. Is that clear? This is what the answer I'm getting. Fine. So basically my time weighted return means over a period it is 30%. Over a period I am saying, not per annum. If I want per annum now, I will take the roots. What I will take? Root means it is obviously it is for 3 periods. So I will take cube root. Is that clear? So generally if I want annualized return, return is always annualized actually. So I will take the cube root. Okay, so cube root, take the cube root 1.299 cube root. You know how to take 1.2999 y raised to x, correct? How much it is? Y raised to x bracket open 1 divided by 3 equal, bracket close equals to, I'm getting 1.0914 minus 1 is 9.14% annualized. Returns are always annualized. So sometimes in the exam be careful whether they are taking the cube root or not. Is that clear? If it is not cube root then it is for the whole period, fine, for 3 years. Otherwise when you take the cube root and then you minus 1, it becomes annualized return. Okay, and generally the return is what? Annualized. Is that clear? So my time over the 3 years, if I ask you, it is 30%. On an average for it is 9.14%, which is the geometric mean. We have already done this. This is geometric mean. Okay, so the same example I have given in the text also, you can go through this. Fine. Now listen, here what happened, there is no additional cash inflow or withdrawal, correct? Therefore this was very easy. Okay, now what happens, please understand the basics. Time weighted return, now the focus is on the performance of the investment strategy. Understood? Means they are not concerned about the cash flows. What is the external cash flows which is coming and going now, it is not uh, concerned about that. Which one? Time weighted return. Just now what we calculated is based on return. Holding period return means what? Return, na? So exactly time weighted return is based on that holding period return. Fine. And money weighted return is IRR. That's it. Okay. Which actually takes into consideration uh, the cash flows. Fine. One important question which they ask in the exam is, please understand, time weighted return, na, it is more suitable for evaluating the performance of the investment strategy or the how much how your portfolio manager has performed. Is that clear? Money weighted return, na, IRR is the actual return which the investor has earned, because it considers the cash inflow and outflow, and obviously both will, for the same data also, both will give you what? Different return. Is that clear? So therefore you should understand, here we actually see the performance of the portfolio manager, and what the actual return the investor earns, the it is given by IRR. This is the main thing. Is that clear? Yeah, I hope this is clear. If you have any doubts, please let me know. Fine. Okay, fine. So moving ahead, uh what else is there? LOSD, I think. Next one. Let's see the LOSD. Calculate and interpret the annualized return measures and continuously compounded rate, and also describe their appropriate use. I think I should stop here. Okay, we'll continue next class. Thank you. If you have any doubts, please let me know. Okay, in WhatsApp also. At the same time, Telegram channel is there. Okay, join that for any discussion. And let me know if you have any doubts. Okay, text me. I hope the topic is very simple. And slowly as we move now, what will happen is, always whenever we are studying, you go through these notes, you should listen to the lecture, immediately you should read the notes, and so that you will understand the examples also. You can point out this, what is the means, if there is some discrepancy in the notes and all, you can come back to me. Obviously it is foolproof, no mistakes in the notes, but if the examples might be something different here, to spontaneously I take some examples notes, the examples might be different, but it is parallel means whatever we have learned in the class, it is related to that only. Okay. Fine. Anyways, so let's do this in the LOSD. This one, these two LOSs we'll do in the next. Okay. Thank you.